Getting an audit notice from the IRS can be very frightening. Here are 4 IRS triggers and what you can do to prevent the dreaded audit. The IRS has up to 3 years after the tax filing deadline to kick off an audit, so keeping good records and not hitting these trigger points will help avoid problems with the IRS. Okay, so number 1, having a large increase or decrease in income compared to the prior year. If your income rises or falls to a degree that is unusually high compared to the previous tax year, you may be more likely for an audit, so be sure to have very good records in terms of what your income is. Number 2, suspiciously round or even numbers, especially those that are ending in 0 or 5s. Now, if every number on your tax return is rounded to the nearest dollar, even though you may have had occasionally an expense that is actually $100, it'll tend to raise a red flag. So for small businesses, the more items on your Schedule C that end in a 0 or a 5, the greater the likelihood of an audit. So while numbers are rounded up or down to the next dollar, don't send estimations. Try to get as close to the real number as possible. Okay. Number 3, you've made a large number of charitable contributions. If you report a large amount of non-cash contributions on your Schedule A and claim deductions for them, it'll attract the attention of the IRS. This is especially true if your income is substantially lower than the value of what you've donated. So cash donations are the easiest ones to prove. But if you should have some written acknowledgement from the organization that's a non-cash donation that's worth more than $250, that's obviously very good if you can do that. For extremely large gifts like vehicles, artwork, things like that, you want to get an appraisal of the value before donating them. Okay, it's always a good idea to do that, and of course, keep those records. Number 4, personal and business expenses mixed together. Big red flag for that. If you don't keep your business and personal finances separate, not only will tax time become way more difficult, but also increase the odds for an audit with the IRS. Okay, you don't want that. So separate out your business and your personal financials by keeping separate bank accounts, separate credit cards, even separate debit cards are fine too. You know, keep them separated. Talk to your local bank about setting up a separate debit or credit card for that account. And I think you're going to be way better off because you'll be able to track individually what the transactions are. Okay, so if you got any value out of this, smash that like button, share it with your friends. I'll see you next video.